Understanding the financial snapshot of your property management business. As we move forward from Section 20, where we aligned our business with needs, goals, and financial structure, we now step into one of the most important financial tools in property management, the balance sheet. If your chart of accounts, Section 20, is the blueprint, then the balance sheet is the snapshot of your business at a specific moment in time. It tells you exactly where you stand financially, what you own, what you owe, and what is left over. And in property management, where you are handling client funds, trust accounts, and operational money, understanding this document is not optional. It is critical for compliance and success. What is a balance sheet? A balance sheet is a financial statement that shows three key components: assets, liabilities, owner's equity. The formula is simple but powerful: assets, liabilities, plus equity. This equation must always balance, which is where the term balance sheet comes from. For example, if your company owns $37,000 in assets, those assets must be supported by either liabilities, what you owe, or equity, what you own outright. Assets, what your business owns. Assets represent everything your business owns or controls that has value. These are typically broken down into three categories. Current assets include cash, receivables, and prepaid expenses, items that are expected to be used or converted into cash within a year. For example, cash in your operating account, unpaid rent, or prepaid insurance all fall into this category. Fixed assets include long-term items such as office equipment or vehicles used in your business. For example, computers, desks, or company vehicles used for property inspections. Other assets may include trust accounts or long-term investments. One key example in property management is the security deposit trust account, which must be held separately from operating funds in compliance with Arizona law. This ties directly back to ARS, paragraph 32(2174), and trust account requirements. Liabilities, what your business owes. Liabilities represent obligations your business must pay. These are also broken into categories. Current liabilities include short-term obligations such as accounts payable, prepaid rent, security deposits. For example, security deposits held for tenants are not your money. They are a liability that must be returned or properly accounted for. Long-term liabilities include items such as business loans or financing obligations. For example, if your company has a loan for office expansion, that would appear here. Understanding liabilities is critical because mishandling funds, especially tenant deposits, can lead directly to violations and disciplinary action. Owner's equity, what's left over. Equity represents the owner's stake in the business after liabilities are deducted from assets. This includes owner contributions, retained earnings. For example, if your business has $37,000 in assets and $1,950 in liabilities, your equity is $1,750. This is your financial position, the true value of your business. Why the balance sheet matters in property management. The balance sheet is not just an accounting report, it is a compliance tool. It helps ensure that client funds are properly accounted for, trust accounts are separated, financial records are accurate. For example, if your balance sheet shows security deposits mixed with operating funds, that is a red flag for commingling, one of the most serious violations under Arizona law. This ties directly back to ARS, paragraph 32(2151) and paragraph 32(2174). Understanding the profit and loss statement, P&L. While the balance sheet shows your position at a moment in time, the profit and loss statement, P&L, shows your performance over a period of time. It answers a different question. Are you making money? The P&L tracks revenue, income, expenses, net income. For example, a property management company may generate revenue from management fees, leasing fees, and maintenance markups, while incurring expenses such as payroll, marketing, and maintenance costs. If total revenue is $20,500 and total expenses are $14,400, the net income would be $8,000. This tells you whether your business is profitable and how efficiently it is operating. Connecting the balance sheet and P&L. These two reports work together. The P&L shows how your business performs over time. The balance sheet shows what your business looks like at a specific point in time. For example, profits from your P&L increase retained earnings on your balance sheet. Together, they give you a complete picture of your financial health. The general ledger, where it all lives. Behind both the balance sheet and P&L is the general ledger, GL. This is where every financial transaction is recorded. The GL includes accounts for income, expenses, assets, liabilities, equity. For example, when rent is collected, it is recorded in the GL, which then feeds into your financial statements. A well-organized GL ensures accuracy, compliance, and easy reporting. This ties directly back to Section 20 and your chart of accounts. Why this matters for brokers in Arizona. In Arizona, brokers are responsible for maintaining accurate financial records and properly handling client funds. Failure to do so can result in audits, fines, or license discipline under ARS, paragraph 32-2153. For example, if your records do not match your bank accounts or trust accounts, you could face serious consequences during an ADRI audit. Understanding your balance sheet helps you stay prepared and compliant. Signatures and financial authority, controlling the process. Financial management also includes proper authorization. Checks, contracts, and financial documents must be signed by authorized individuals. For example, maintenance expenses or vendor payments should follow your company's approval process, as outlined in your property management employment agreement. This ensures accountability and prevents unauthorized transactions. Electronic systems, modern financial management. Today's property managers rely on electronic systems for financial tracking and reporting. Electronic signatures, digital accounting platforms, and cloud-based systems allow for efficiency and compliance. For example, platforms like AppFolio or Buildium integrate accounting, reporting, and document management into one system. This ties directly back to Sections 18 and 20, Technology and Efficiency. How this section connects to the entire course. This section brings everything together from a financial perspective. You've learned the laws, built the systems, defined your services, and aligned your goals. Now you understand how to measure and manage your financial performance. Because at the end of the day, property management is not just about managing properties, it is about managing money responsibly and legally. Online discussion. Why is the balance sheet important in property management? Answer. It provides a financial snapshot of assets, liabilities, and equity, ensuring proper handling of funds and compliance. How does the P&L differ from the balance sheet? Answer. The P&L shows financial performance over time, while the balance sheet shows financial position at a specific moment. Why is the general ledger critical? Answer. It records all financial transactions and ensures accurate reporting and compliance.